Executive Chairman of Exergy and Professor of Energy at Strathclyde University, and Yasser Al-Malki, Gulf Analyst at MEES, Middle East Economic Survey. Thank you, gentlemen, for joining us. A lot to get through today. Matt, I'd start with you. Forget about what a difference a day makes, what a difference an hour makes, right? I mean, what is happening now with these markets? How are traders now viewing the volatility that we've seen on the oil chart, and what's their likely positioning going to be just for the rest of this week?
Morning, Diala. Yeah, look, it's exhausting to say the least. You haven't got time to sneeze. If you yawn, you've lost $2 a barrel. The problem is, because it's so volatile, people don't really have a trading position on. It's especially flat price. If we let's just go back 3 months when we used to talk about nice things like, maybe my Christmas presents are not going to arrive on time. And now we're talking about chaos, a new world order. Prices 3 months ago on Brent were just above $70 a barrel. We have doubled in 3 months. Forget COVID. I mean, that is so yesterday. It's so boring. It's so 2020 and 2021. We're talking about complete new world order here. There's many factors, and we could, like James said before the call started, we could talk for an hour about one specific topic. So we'll try and broaden it and generalize it. The biggest issue to me right now that the world is not acknowledging is the impact this is going to have, the Russian war is going to have on trade finance in the commodity sector. Forget about fossil fuels and is there enough investment in fossil fuels and the green agenda. Banks have taken many hits over the last few years on traders. Singapore, Hin Leong, for example. If you've got the Russian sector being sanctioned, they are going to lose money. It's as simple as that. And that's going to have such an effect down the chain within the next 3 weeks, we will see. And I think we will look back at $130 a barrel, that was a good time for oil. That was when the end user could just about cope. So God knows when we'll be at the end of this week. I don't know. Okay,
well, we'll get on to sort of the whole commodity spectrum and trade finance, as you said, and bank finance. But just to stay with you, Matt, for a minute, we had obviously the US, the news overnight and yesterday was that the US did proceed with announcing it's going to ban Russian oil imports. The UK joined it. But at the end of the day, it didn't really have a huge impact on prices yesterday when it was announced. Slight blip. We know that because obviously those two particular countries aren't, extremely reliant on Russian oil imports. But so has the market priced that in, or are we going to see more of an impact? Our audience yesterday said they were expecting that the US would do that, so they were correct. And so what impact is that going to have, if at all? Because at the end of the day, it's Europe that's going to be affected.
I think you're right. It's been largely priced in. The problem is, again, I'm sorry, I'm not trying to create problems on the questions you're asking, but the world is so ambiguous that one issue raises so many other questions. And I think that this is being reflected in oil trading at the moment. What do these sanctions mean, right? The UK do what the UK do best. We need to act now at the end of the year. That's kind of what they're doing. The can has been kicked down the road and they've signaled their intent. In prompt trading, it's not going to have an immediate effect. That will start flowing. Urals is persona non grata. It's as simple as that. Russian crude oil is persona non grata. However, if we look more complex at what Russia export, it's 20% of global high sulfur fuel oil. All of that high sulfur straight run fuel oil at the moment is going to the US Gulf Coast because it's a high yielding and say distillates for gas oil. You get a lot of gas oil and gasoline out of it. And it's cheaper than crude oil. So what is the effect going to be on refining margins in the Gulf Coast? They go through the roof, which they have done. If you take the 3-2-1 crack, which is 3 barrels of crude oil into a Gulf Coast refinery, 2 gasoline out and 1 gas oil, it's at record highs, $44 a barrel. It was $20 a barrel a month ago. So the impact cannot be just boiled down to what happens to crude oil prices. It's the whole oil complex. And to me, it only means that we're going to continue to pay record high prices globally for end user products like gasoline and gas oil.
James, let me go to you on the what has been sort of talked about in the last 2 days, if not last year, the sort of tail end of COVID, which is, where are these higher improved oil prices going to, what are they going to do to the energy transition argument? It was almost reversed in a sense. It was almost saying, but what this crisis has done, obviously, is again, reinvigorated the conversation. We don't have enough oil and gas now for the next 10 years. So, is this crisis going to finally trigger reinvestment into oil and gas and away from transition, or the reverse? I mean, at the end of the day, it's emboldened Europe to sort of say, oh, we need to sort of lessen our reliance on Russia, but that they can't do that overnight. So where is this? No. Where are the investment flows going to go in the next 2-3 years because of what we're seeing today?
So that's a huge question, Diala, and has multiple aspects to it. Clearly, so if we break out oil and gas, there's clearly still a different sentiment around investment into oil and investment into gas. Over the course of the last few weeks, even prior to the war, we began to see a shift towards the acceptability again of gas as a transition fuel. And if gas is indeed accepted as a transition fuel, that will allow capital to flow into that market. But let's not forget that big new gas fields can take decades from discovery through to development. So this is not a short-term fix. In terms of renewables, there's an interesting article on the wires within the EU Commission where they are driving further investment into renewables. In fact, they're actually referring to investment into things like floating wind and solar as the short-term solution. There is no short-term solution to the problem we find ourselves in, but clearly there is a view that might be a shorter term, and there is an immediacy to that if you can create the
wind and solar don't power
investment to invest into renewables.
Yeah.
No, absolutely not. I think before we came on the call, Diala, we were having a lively discussion around a point which I think is unprecedented for us now in the last 4 decades. And I pray that this time the energy industry actually gets a hold of it and does something positive in that space. And that is the wide acceptance of the connectivity between energy security and economic security. The energy industry over the last 4 decades has seen itself increasingly marginalized away from the political discussion, away certainly from the social discussion. And in terms of what the energy industry is able to do around that economic security argument, but also around what it is able to do for the planet in terms of energy diversification. We are right up front and center now in terms of the wide political discussion and in terms of the wide economic discussion. And we have to use this moment to actually build off of that. Now, it's not going to fix things in the short term, Diala. Very little is other than an end to the war, and then even there, there is going to be a reshaping, if you like, of the energy markets. And I think that's a very good thing. But clearly your question was, is this going to favor more investment into oil and gas opportunities? I think almost certainly yes, but not wholesale. Is it going to favor investment into renewables? I think yes, but that will involve the politicians getting involved in big conversations around tax incentivization.
Yeah, thanks, James. Yes, sir. Just to you on that one point that one of the points James made, which is, obviously it's not going to fix things overnight in terms of where investment flows are going to go. And the other argument being made by OPEC and other analysts in the market is that even if OPEC did add the 2 to 2.5 extra spare capacity it has to the market today, which is of course refusing to do so far, that is not going to calm these prices down. So is OPEC right or is the IEA right?
I mean, let's put it simply this way. The UAE Energy Minister, former Secretary General Bakendo, when he was at IHS Week, they basically put it in simple words. If Russian oil goes off the market, we cannot replace it. Even, Saudi Arabia and the UAE are supposed to be the countries with the spare capacity. So they have around 3 million barrels per day between them. And you have other countries like Iraq and Kuwait have another 750,000 barrels per day of spare capacity. Iraq is very questionable. I cover Iraq a lot for me, and I can tell you that even the IEA saying that their spare capacity is down by 140,000 barrels per day can be a good estimate, to be honest with you. But anyway, to look at this, the argument that OPEC is putting out is that if we, as OPEC, go through our spare capacity, we are going to shred it too early. We have the summer driving season coming over, and by then, if we have gone through the whole spare capacity, then there is nothing really extra to add, and this is going to eradicate all the spare production capacity and leave the market vulnerable to further disruptions in the future. So this is what OPEC, was talking about on their 2 March 13 minutes meeting on, the fundamentals being well balanced, because they saw that at the beginning of the conflict at that point, that, that additional $10 to $15 of upside on the oil price is simply the Ukraine Russia crisis and has nothing to do with those fundamentals. But now, today, we are in a different ball game, as our American friends say. OPEC might actually be pressed to reconsider its position, but for it to reconsider the position, there are really few things that it needs to look at. First of all, we need to understand, because remember, we are just talking this week, and just to say one thing, to comment on what Matt was saying, I feel like we are Joe Frazier on the ropes, and the whole market is Muhammad Ali, and just hitting us in a way. So OPEC has to understand how much Russian oil was lost, really. Is the loss permanent, or is it something temporary? Are governments going to undo some of these measures, sanctions? When are they going to do them?
Yeah. So I guess it's a question of monitoring day by day, if not hour by hour, and OPEC will continue to do that. And most importantly, Russian sort of supply fundamentals. But yes, just to stick with you very briefly. So Iran, just to get your thoughts on that there is, again, a week or two before this Ukraine crisis exploded, the Iranians and Americans were supposedly making progress. Floating Iranian oil in storage is ready to release. Do you see that happening? Would that really make a dent in what, again, the argument of will it make a difference to prices as long as the war is going on?
Listen, there are so many moving parts to this, and give me a second to tell you what's happening. So we have two thorny topics here when it comes to an Iran deal. One is that IAEA probe, and apparently that is going by June, which people are saying is the re-implementation day. I'll come to that point later on. And then we have the guarantees that Iran wants. So even saying that those things are agreed, how much floating oil is out there? There are so many different estimates. You can go from as little as almost 60 million barrels to as high as 100 million barrels. That is going to give a temporary boost to the market for probably 60 to 100 days for 1 million barrels per day. Previously, I was speaking to Sheen, and I said, well, the Iranians logically want to space out all of that oil going into the market. But today, just, 2 weeks after, the situation is different. And the Iranians might be needed to actually boost the market with all of these extra oil. But then, after they run out of it, it's going to be the production ramp up on their domestic, on their onshore oil fields, which will take a lot of time. Yes.
Matt, just back to the commodities argument again across the board and products, and we're just not talking about crude oil. Jet fuel is one of those that you clearly follow. Again, it's had a complete turnaround last year, not recovering with everything else, and then finally getting some support. Now we're facing a situation where it's obviously up with everything else. And what impact is that going to have on sort of forward buying of that for airlines, etc., and hedging on that front?
Yeah, it's a good question, Diala. I mean, I flew back to the UK a couple of weeks ago just for a long weekend, and it was busy. It was busy. I think I just want to go back to the question you just asked, Yasser, about Iranian crude, because it leads on to refining margins and what happens to things like jet fuel. There is nothing that can replace Russian oil. Okay, let's be clear. And I totally agree with what James said. There is not a short-term fix, whether that be in the transition argument or where we are in 50 years' time on zero carbon. Right now, the world doesn't have enough oil. However, the closest grade to replacing Urals is Iranian light, right? In terms of the density and in terms of the sulfur. Majority of feedstock that European refineries run off, in fact, were built off, was based off Urals crude, especially Germany. As Mike Muller told Sean on Sunday, the diet that German refineries run off is more or less 100% Urals crude. You can't replace it, but if you're looking for a like-for-like crude slate so that you can run your refineries in Europe using a similar feedstock, then you'd look at Iranian light. Now, I would think that will put pressure on the Iranian debt in Vienna. I think the EU will use this as some leverage, and I think that there's probably some talks going on in the background in the immediate to release any barrels that are in floating storage or wherever they are. First port of call is Wilhelmshaven or wherever in Germany or Northwest Europe into Antwerp, Rotterdam, or Amsterdam. So I think that's a very important point the market will look at. How that's priced, I think, will be off-dated. So I think that the dated market will spike. Where does that leave refining margins for jet fuel? Look, jet is still a dog. Let's be honest, right? It's still that 60% of what it was pre-pandemic. Even if you've got people like Fly Dubai coming out with stellar numbers for last year, demand has picked back up. I disagree with the argument regarding demand destruction, right? I think it will have an impact on jet fuel because people are not going to say, well, I want to go on holiday. I'm going to take the family to Corfu or the Costa Fortune or whatever you want to call them, right? They're going to say, I need to pay my energy bills and I've got to feed my family. So I think people will stay at home. But people still need to get to work. My daughter still needs crayons to go drawing. You know, the demand for oil is still there, but I think that the demand destruction will only happen when people want to spurge some cash. And the one thing that will happen as a result of the invasion is that people will become incredibly insular. So I think it's going to be a tough year again for jet fuel, but it's following crude oil. The margins are coming off, but it's moving, flat prices so high and it's moving so quick on Brent that jet fuel has only got one thing to do, and that is to keep up. But it's come off in terms of where values are on, say, the regrade, we call it, which is the difference between jet fuel and gas oil. It's weaker than it has been for a year. So I think that is a victim of demand destruction for jet fuel especially. But I think that product demand, gasoline and jet and diesel, as Yasser said, driving season's coming up. People will stay within their country, and there simply is not enough oil to supply that demand right now.
Okay, well, let's talk about demand destruction. James, back to you, and let's talk a bit about Asia, a huge, obviously, consumer of oil and gas. And clearly, you know, at what price we could start saying, would that demand destruction kick in? And there's talk now of GDP forecasts being dropped a percentage or two, global recession around the corner, stagflation, etc. But let's look at China, just to start with one point of focus. It had not such a great year last year in terms of relative growth, but people were ahead of this crisis saying, well, it's going to have a much better year this year, and the government policy is going to switch back to supporting the economy, etc. So how are countries like China and India looking at these prices? Clearly damaging, and how do you think that their economies will cope?
Look, I mean, I guess the complexity of this conversation is that there are elements in every one of our conversations which are right, and there are elements in it which we should rightly question. There is clearly going to be demand fall off as a consequence of where the energy prices are right now. Whether it's right to use the word destruction, which of course conveys wholesale fall away, I think is probably not right, which is the point which Matt is actually making. But there will definitely be fall away from that. For that a second, a perfect example of that is the article where UK driving is potentially going to be off 30%. We'll come back to that in a second. In terms of the macroeconomies, we hear week in, week out on your forum that India requires $72 oil for their economy to work. We hear week in, week out of the huge demand for product that China needs to maintain, its 5% growth for the coming year as it presumably invests increasingly into infrastructure projects to replace the fall away in residential. I don't think anybody would back against China, Diala, in terms of actually achieving somewhere between the sort of like the 4.5% and 5.5% growth projections, which are out there, depending on whether you listen to the international banking community or you listen to what's coming out of the Chinese government. So I think they will grow, and I think they will find ways of actually changing their energy mix. Remember that China runs off of a much more traditional mix in terms of energy generation, including very large amounts of domestic coal in terms of what it does. So I think China is less vulnerable,
and it'll resort to consuming more coal at the moment.
Yes, as will Europe, Diala, which is back to your original question. About how does the energy mix change? The energy mix is going to change in the short term because it has to change in the short term to meet this shortfall of Russian oil. And Yasser is absolutely correct when he says that when OPEC comes out and says we cannot replace the whole volume of Russian oil in the marketplace if it falls away. One other thing I would pick up on, though, in terms of the supply dimension, and clearly in the short term, this is an issue around how one replaces the supply dilemma or what is actually happening on the demand side. In the supply space, we are seeing the IEA coming out and saying they're going to potentially release 60 million barrels of supply into the marketplace. That's 4% of apparently their worldwide stored reserves in terms of emergency supplies. We're talking about Iranian crude coming back into the marketplace. And clearly the mathematical exercises is that cumulative amount divided by the amount that Russia actually produces in its simplest form. And Matt is absolutely right about the composition of Urals crude being very, very specific. But we will see demand erosion. And I think where we're going to find ourselves is governments are going to be caught in a place where they can't be going back to try to subsidize and finance the economy to work off of its habit that it had before. So it's going to have to allow for certain increase in prices to hit the pump, et cetera, and see that fall off in demand. But they're going to have to also politically address the issues like Iran to create a supply into the market that in actual fact will also have a pullback effect on the almost unended rise in terms of prices. So I think, very long answer. China, I think, will ride the storm. India, I think, will struggle in terms of prices staying up above $80 a barrel. And I think the European governments will look to maintain alternative supply, but also allow increased prices in the market, which will cause people not so much to go on long-term flights or holidays in the summer, and definitely not to climb in their car.
Well, I mean, Europe certainly is going to bear the brunt of this immediately and long term. And, even if stock markets are doing much worse than the US, and they're all obviously falling. We'll just have a look at our poll there, which is after the current shock and awe, the supply disruptions, will Russian barrels eventually find their way into Europe and Asia, where at least for the time being, there's no import ban? Yes or no? And we'll obviously get the answer to that. Of course, we've seen, not to compare, but Iranian barrels found their way to China in terms of what was available under sanctions. So one would assume, and of course, we've got the other argument that Russia now is talking about threatening and blocking other commodities itself from getting to Europe. Matt, just to go back to you, and not specifically to talk about fuels, but just to get your viewpoint on America. Let's go west again, we've made the point that the US is less vulnerable to all of this in terms of oil imports, certainly not in terms of oil prices, perhaps at the pump. But the whole Fed policy that has been just about getting going this year, and they're about to have their first interest rate increase. With what we're seeing there, and this sort of whole uncertainty in global debt finance, trade finance that you mentioned at the beginning, commodity rocketing, inflation. How is the Fed going to deal with this continuous inflation, but its equity markets need some support? Are we going to still see the same hawkish policy, do you think, continue this year?
Look, again, that's a good question. One the market's going to look at. If you look at, it's difficult to answer because the Fed are reacting to inflationary pressures and trying to keep a lid on that. If we go back to where commodity prices are, we look at, say, nickel. Right. And I never look at the price of nickel. I mean, if you'd have asked me a year ago what the price of nickel was, I said, I've got no idea. I don't really care. It went up $33,000 a ton yesterday, which is 70%. Now, what does nickel go into? That goes into making golf clubs and galvanizing and all that kind of stuff. With that kind of inflationary, that kind of pressure on commodity prices, I don't think the Fed will know quite what to do, or they know what to do, but quite how much to do it by. So I think that the market is priced in probably a 50 basis point rise in March. That's pretty much locked in. It's what they do after that. And all they're going to be is incredibly reactive to what is happening globally. And the supply shocks that we are seeing over the last 2 weeks from the invasion haven't really been felt by the end user yet. Like I said, there's a 3-month lead time. What does that have an issue on supply shocks, or I don't know, but they will just be all eyes on what's happening with commodity prices, especially.
And I mean, we haven't even talked about food prices, and wheat, of course, being one of those commodities that has taken a huge boost. Yeah, so just back to you on that front, this region is a huge importer of food, obviously, and so it's going to be importing that inflation as well. But at the same time, the Gulf, I mean, and it'll affect populous countries like Egypt more, but the Gulf is probably not thinking things are too bad from a revenue point of view with these increased sort of windfalls into its coffers. You know, how do you think the Gulf economies here are going to manage those revenues this time round?
I mean, well, we have a positive coming from the COVID crisis, where, you know, many of the diversification plans that, you know, started being devised in the Gulf region are somehow being implemented. You know, we see VAT taxes, we see taxes on income, things like that. So there are reforms that have been, in a way, aided by the COVID crisis. Now we are coming back to a windfall, as you said, windfall period. Now, the Gulf countries, the GCC countries, not all of them, but, you know, the main ones who are oil producers like Saudi Arabia, the UAE, Oman, and Kuwait, they have sovereign wealth funds. They are going to use that money to shield the market, especially when it comes to food prices and energy prices, so that households are not going to see much of an impact. But that is not the case to the rest of the Middle East, and there are countries that are going to be hugely impacted food-wise due to wheat prices increasing because wheat comes from Ukraine and Russia. Iraq is one good example. Egypt is another. Tunisia. So most of these countries now. I've been reading
just stop you there, Yasser, just for a second. So yeah, I mean, and again, a risk of social unrest perhaps again in the region. And sorry, Yasser, because we're running out of time. James, just back to you on that. And of course, we've got the whole commodity gas price. I mean, I think gas prices, correct me if I'm wrong, went up 140% in the last week. I'm not sure if the chart I saw, I read correctly in Europe. But James, just wanted to get back to you also and just ask your opinion on, because we haven't had you on the show since one or two of the IOCs have said they're withdrawing from Russia. Withdrawing investments there, whether it be you know, the stake Shell had in Rosneft, etc. You know, I mean, is that symbolic? I know it's true and it's happening, but of course that will take months to sort of you know, execute, if you like. So how significant is this move of the IOCs pulling out of Russia, and do you think they will stay out once this crisis is over?
Well, it's significant in as much as that the IOCs have been very public about the fact that their intention is to use the proceeds from hydrocarbon production to fuel their energy diversification agenda. So the reality is where they have large interests in Russia, where they would have previously expected to profit from the production in that area, if indeed what was being said is correct, that those profits would be diverted into their investments into renewable energy. So they're in a difficult spot right now. And in fact, I mean, if you take a look at the super majors, you know, BP, Shell, you might reasonably have anticipated that off the back of these kind of oil prices right now, their share prices would be surging. But in actual fact, BP is down 11% on the month. Shell is barely above into positive territory. So the reality is the markets are struggling to come to terms with the fact as the impact on the super majors and what it actually means for them. They're not getting the benefit, if you like, from these high prices because the markets aren't giving them that benefit. And indeed, it is very interesting to know. I mean, you're absolutely right. I frequently talk around the impact on the broken service sector. We have seen a very positive move in the course of last month on some of the major service companies. You know, they themselves are up about 15%. Halliburton, Schlumberger, for instance, and the USX index is up about 20%, but it's not coming from rig count, other than perhaps offshore international rigs, where there's been a slight increase. The US rig count is trading sideways. Now, why would that be happening? I think deep down it's because the world is beginning to realize that we've gone too far away from the world of investment into production, particularly gas. And there's going to have to be a correction in that space. Who will benefit from that? The big service companies will benefit from that. Not so much the rig suppliers, because it's longer term in terms of all of that. So the reality is, it is impacting the super majors, and it is not enabling them to take advantage of the profits that they would have previously expected to get from Russia, and they have no alternative to replace that either. So we're in a difficult spot. But last thought for you, Diala, if I may, is just I sincerely hope that we don't end up in a place where the politicians simply use the hammer of windfall tax on the major oil and gas companies in this current environment to seek access to capital to feed back into the consumer environment. I deeply, deeply hope that what in actual fact happens is that the energy industry and the politicians finally get together and come up with a concerted, well thought through, thought leading energy policy for the countries in which we actually operate. Here's hoping.
Okay, well, I think we'll have to end on that note. Thanks, James. Yeah, it's where the economics and politics come together and work in an ideal scenario. We've just seen that poll result. So yes, most of our viewers think that Russian oil will still find its way into the market, which is a good signal for prices in the sense it's slightly bearish tone and might calm things down a bit if that's the case, but a long way to go. Nevertheless, thank you, gentlemen. We've run out of time. Thank you so much for joining us, and look forward to seeing you very soon again. Thank you to our viewers. Thank you.
Diala, thanks.
Thank you, Diala, Matt, Yasser. Nice